What's up, everybody? Jonathan Rose, owner, Masters in Trading. Today, we're going to talk about relative value trading, and we're going to go over gold futures, oil futures, silver futures, and look at the relationship over the past 10 years. Let's get going. All right. So I have you at a chart. This chart, it's a lot easier than it looks. The green line is going to be oil minus 10-year future contracts. The blue line is going to be gold minus silver. This is the gold to silver ratio. The purple line is gold relative to oil. Going back to 2011, I'm on Thinkorswim. Right now I'm using something called Metal's Edge. Metal's Edge allows us to easily look relative value for any metal contracts. So again, going back to 2011, gold-silver ratio got pummeled, came straight back, but at the same time you can see gold relative to oil got more expensive. So how could you take advantage of this? Well, when this happens, you could get long gold, get short silver to take advantage of this relative value relationship. Every single Monday, I have a live class with my members, and we always talk about what we're going to do for the week. This week, yesterday, I talked about the blue line, the gold-silver ratio. The gold-silver ratio is trading at the highest that it's ever traded at. I took you back 10 years. You can go back 40 years. It's never traded this high, and whenever it does, it comes back pretty quickly. So what does that mean? Well, that means that gold is very expensive relative to silver. The purple line, gold is very expensive relative to oil. I like being long oil. I'm a big believer that traders need to control their position. Traders need to have a view. For instance, my view right now is oil is very cheap because of its relationship to gold. Silver is very cheap because of its relationship to gold. So one of the trades that I shared on our live member-only class yesterday was, guys, silver is stupidly cheap. How can we get long silver? Well, we can buy silver futures, fine, or we can find companies that are going to benefit as silver strengthens. My favorite silver company, Pan American Silver. Here's what I suggested on the live class yesterday. I still freaking love this thing. Last trade, 21.20. You can see it dipped below its 100 period moving average, got right back above its 100 period moving average. The trade that I really like, let me take you to the option screen, is PAS, April, 45 days out, buying the 22 strike. And here's a trade that I did yesterday. I was live. Everyone's skeptical, so I want to do trades live for the members. Trade price, $1.15. The mark's $1.27. I don't care. This is a rounding error. I am holding this, and I am holding this trade until the gold-silver ratio drops down. I'll go back to that chart in a second, but let me just expand on why I'm doing this trade. I'm doing this trade in PAS because, again, silver is very inexpensive relative to gold. Looking historically, I also like this because I know exactly what my risk is. I'm in this trade for $1.15, 10 times. My risk is $1,150. If PAS goes to zero, I can never lose more than I invested, that $1,150. If PAS rallies and goes higher, I'm going to be, in effect, long 1,000 shares from 22. That's how you can look at this. So if it gets to 25 at expiration, these options are going to be worth 25 minus 22, $3 less the $1.15 I invested. So it'd be $1.85, $18.50 winner if the stock goes to 25 within 45 days. I personally think 25 is not that big of a deal. I think we can go back to taking out highs because, again, gold-silver ratio, guys. Gold-silver ratio trades above 90. Historically, it's come back 100% of the time. Check it out. If you want to learn more about me, go to mastersintrading.com. My name is Jonathan Rose. We teach relative value futures and options trading. Thanks so much, guys.